Good morning, it's Jeffrey Christian. I'm actually coming to you from Vancouver today. It's Friday, the 20th of May. Um, I was out here this week for the Vancouver Resource Investment Conference and a variety of other meetings and such. And I'm still here and coming to you from sunny Vancouver. The Vancouver Resource Investment Conference, briefly, was very good. It's the first time in 2 years, obviously, that they've had it physically. I think it was reasonably well attended. And at the end of it, the final session, Jay Martin asked me what my major takeaway was. I said, I saw a much more sober view among a lot of people toward the state of the world, the state of the economy, the Fed's ability to be a professional central bank, and reasonable expectations for gold, silver, and metal prices. There were the crazy people who don't know what they're talking about $10,000 gold and $1,000 silver because the Fed has lost control and the dollar is going to collapse. But they were much fewer and farther between, and they were much more ignored, I think, by a lot of other people who had a much more somber and realistic approach to the world around them, the financial markets, and the precious metals and base metals markets outlook. But here, let's talk about gold and silver. They're still standing. They fell with the rest of us. They fell with stocks and bonds. And then they've recovered some. They didn't fall as much as stocks and bonds have fallen. And they're showing better strength after the fall, if the fall in fact is over. This could have just been the first leg of a two-legged or even multiple-legged downward move. But if you look at gold, in mid-April, gold was testing $2,000. In mid-May, it was testing 1,800 on the downside. It got up to about 1848 2 days ago, yesterday or Wednesday, and it's about 1835 as I speak. Silver was testing 26 on the high end in mid-April, and it was testing $20.50 on the low end in mid-May. I mean, that was $1 lower than what we thought would be the floor. It has gotten back up and tested $22 over the last few days, including today. CPM Group still thinks that the markets are good and strong, but we do think that there could be some short-term profit taking. And we issued gold and silver trade recommendations to our clients today saying we had long trade recommendations on gold and silver that we put out earlier in the week when the prices were lower than they were. When we were looking at higher prices, $22 for silver and $18.50 for gold. So silver got to our $22 target. Gold got within 20 basis points of our 1850 point. And just looking at the markets and the economic environment right now today, we issued stand aside recommendations. We said, things could go higher, but they're looking a little bit tired. They've done well, and they could come off in the next 5 or 10 days. So we issued short-term trade recommendations. Our longer-term view has been and continues to be that we could see some weakness. And if I look at the world and the economy and the precious metals markets, I think of two songs together, and it's not Elton John Still Standing. It's the Shirelles 1961, Mama Said there'd be days like this. And then Van Morrison did a light on it many years later, and he said days like this, which was a more positive view. There'll be days like this when everything seems to all of a sudden fit. And that's sort of where we are. We've got a lot of problems, but there are some things going better. So I look at gold and I look at silver and I see strength and I still see support. Over the summer months, we're worried about interest rates continuing to rise, having a negative effect on prices. There's seasonal weakness in gold and silver prices due to rolling vacations on the part of jewelers and electronics companies and other fabricators. investors oftentimes pull back on buying during the summer months because they're on vacation and they're just taking it easy. The converse is while they're on vacation, they realize how worried they are about the state of the world stock market. And when they come back in September or October, they sometimes buy gold and silver. So that's the seasonal strength that you see in September and October combined with resumed demand for gold and silver from fabricators. But you have seasonal weakness, you have rising interest rates. The inflation, the data has started to peak and come down with April's data, as we had explained in previous videos. And it probably is going to continue to show lower growth rates in inflation. We are seeing some quelling of inflation expectations in the broader financial markets, if not the gold and silver bugs. So you've got that. And Ukraine is showing a lot of strength. And over the next few months, it'll be very interesting to see how the Russian invasion of Ukraine plays out. But it could play out in a way that reduces the war premium even further. So those are Van Morrison's side. The others are that Russia is still beating the heck out of civilians and infrastructure within Ukraine. You still have a lot of inflation fears, even as they have dissipated some. And we have the midterm elections coming up, where the government leaders will demonstrate as forcefully as possible how incompetent they all are, and how we are beholden to their incompetence. So I think there's some positives for gold and silver that'll keep those markets stronger than, say, the stock market and the bond market over the next 3 or 4 months, but may not propel the prices higher given the headwinds of higher interest rates and those other factors. Longer term, we still think gold and silver will rise much higher. In terms of the economy, it's a similar situation. You have some weakness, housing sales, but you have some strengths. Housing starts. Housing starts have shown a lot of strength right now. Housing sales are down because housing prices are up. And who can afford this other than investors who are going to turn you into a serf and rent to you? So housing starts are showing weakness. There are signs of weakness in the rising labor costs, but there are signs of strength. Housing starts are up, non-residential construction's good. Capacity utilization is far from the levels where we normally see it impeding further growth. So our expectation is that there can be continued growth. Yeah, there's clearly a recession on the horizon, but it may be 2 years before you see it. It may be now. It could be the second half of this year. The politicians do their job particularly well. Or it could be 2024, 2025. When I went to Goldman Sachs, I reported to Gary Winklowski, the chief economist, who reported to Leon Cooperman, who was head of investment research. And Leon was and is just a fabulous fellow, despite what some people say. And Leon used to say that the stock market had predicted 14 of the last 5 recessions. And I've used that before. Just recently I said that money supply had predicted 14 of the last 1 bouts of inflation. But it is true that you can have the stock market fall sharply and not have a recession. In 1987, the stock market was wobbling and then it fell. We had Black Monday, where the stock market fell extremely sharply. Gold went from, I don't know, $340 to $500 in a very short period of time in late 1987, because there were any number of people who saw the decline in the stock market as a sign of an imminent recession. Alan Greenspan was the Fed chairman at the time, and he and the Fed looked at the economy and said, no, the stock market fell because of stock market reasons, not because of economic reasons. And there were a lot of people in the financial markets begging the Fed to cut interest rates to keep us out of a recession. It did not. That was October of 1987. And CPM Group, by the way, said, yeah, we don't think this is a recession. This is a stock market event. We think that gold will fall back from $500, and we think that there won't be a recession until 1991, and we won't see rising gold and silver prices for several years. We had a list of like 5 factors that we were seeing depressing gold and silver prices for the next few years, and we had about 4 factors that we were looking for before we would turn bullish. And we said that we thought gold at 500 was peaking, and it would head back into that 320, 360 range. And we told our silver clients to sell as much silver as they dared, because we probably wouldn't see prices as high as they were in late 1987 for many, many years. And I think it probably was 1997 to 2005 before you saw silver prices that high again. And so just because the stock market's fallen doesn't mean that the recession is imminent. There is a recession on the horizon, just not quite sure where that horizon is. So there'll be days like that, you can be assured. And there'll be days when everything seems to fit. And in that kind of environment, you're going to see increased volatility across financial markets and the political spectrum, not just in the United States, but in Europe and other very important countries and regions. Russia's up for redefinition. I won't go into all the details of other countries. Europe is going to be very interesting to watch, as will be other parts of the world. There's going to be a lot of volatility, a lot of uncertainty, and a lot of reasons for investors to say, we should be buying gold and silver. It's time to stop watching people talk about gold and silver on YouTube and actually start buying it, because that actually is what drives the price. Have a good weekend. I'm sorry if I'm a little bit raspy in the voice, but we'll come to you next week and we'll continue the conversation.